Yo, what's up, guys? Today's video is about earnings and trading earnings, swing trading around earnings, why you should, why you shouldn't, things you should watch out for. So, um, Nvidia had earnings today, or yesterday after close, but today was the first traded day where we realized what happened. So, Nvidia made a huge move. This is the all-time high, actually. So, seeing it break that and really break it strong is pretty crazy. So trading around this is not like trading any other day. There are some nuances to it. So let's say we're at open today. So I'll go to the 1 minute chart. We open right here. Let's draw a box. This is where we open. I mean, in this example, you're not going to play calls, but let's say the stock, had to move up to this pre-market high, come down, something like that. And then you want to play that high. In a trade like this, if it's directly off the open, there's going to be a pretty heavy IV crush, which is implied volatility. And when you're trading options, implied volatility is priced into your contracts. So when the implied volatility goes down, your contracts are going to take a hit. So for example, this is Nvidia. These are the options. To find the implied volatility, it's right over here. And right now it's at 78. So I know when we opened, because I was watching it today, when we opened, this was at 130. So let's say the stock slowly grinds up and the implied volatility goes from 130 down to 78, you'll still be down in your contracts. So I'll show an example of something that someone might have done. So this whole area, this is 10:01 to 11:10. Let me just do that. Okay, sorry guys, just 1 second. Oh, okay. So this high that it put in was 385. Literally 385 to the penny. So that is good. That's what you want to see. So okay, 385. Let's say you're playing 385 calls. Let's start with this, and I'll show an example with a different contract. Let me just copy that and then paste that here. Go to 1 minute. This is a perfect example of what I was trying to explain. So I'll just set an arrow at each of these. So this is 10:01, 10:01. So the high it made this minute, the contract's high was 925. We come back up, we're at now 384, or we drop and then come back up. The high of this candle is 384.30. Let's see where the contracts go at that point. 10:30. So the contracts at that point are down. They're down 13% after the stock is pretty much back to the same price. So that's your first example of volatility crush. Now let's go to where we come back up again. It's 10:48. This high is 384.50, so we're still right there. 10:48. Let's see where contracts are at. Now you're down 28%, almost 30%. Well, if you come down here, you're down 42, but down 38%, or no, 28%, and the stock is pretty much at the same exact price. So from those last two highs, the stock is at the same exact price and you're down 17% just by holding. So this shows you on a graph what the implied volatility crush looks like. So when we finally break out, oops, my bad. Oh my god. So when we finally break out, it's 11:10, and contracts are still down. So if you get in at this first test, and let's say your stop never hits, one, you have a really wide stop because it went down $8, but also you're still not profitable on this trade yet. You see, you're still down 26%. So that's why trading during earnings, during a constant implied volatility crush, it's not something you want to be holding for too long, because these contracts aren't going to hold up well if the stock isn't moving in your favor. So something like this, that's a bit of a different story. So let's look at when we actually break out. If you break out there, that was there. Now seeing contracts actually move in your favor without really any pullbacks. This is a slight pullback, but that's not the end of the world. This is a move where you can hold as long as it's going in your favor. If it's consolidating for a long time, your contracts are just gonna constantly lose value. And today's Thursday too, so it's closer to expiration. But this is with pretty much any earnings play. You're going to be constantly losing IV, implied volatility, and it's not going to be good for your contracts. Even if the move does go in your favor, you're not going to get paid as much as you normally would, because that IV is coming down, which is taking premium off of your contracts. So these contracts are priced with premiums. So you have time value, implied volatility, and there's a whole bunch of other things that go into it. But the implied volatility during earnings is one of the main things that has a big effect on the way contracts move. So if you caught a move like this, obviously you get paid a lot, 86%. But this is also a 85, it's like a $10 move. So you would expect to get paid a lot. A $10 move to get paid 86%. One, 86% is really good. But two, also, that's not, if it was a normal day with no news, no nothing, you probably would have got paid 200%. So that just shows the implied volatility and what it can do to contracts. So taking any trade directly off open is really risky. Oops. Because let's say the stock does go in your favor, the contracts aren't going to move as strong, because no matter what, you have a weight being put on it because the implied volatility keeps ticking down. But that's one thing you need to be cautious about in earnings. So when I play earnings, I usually like to wait a couple minutes just to let that implied volatility settle before I get into a trade, because right off open is the biggest hit. 17. Yeah, like literally this first minute, contracts went from $17 to $7, which is insane. And let's say the stock is slowly moving in your favor, so you're gonna move like this. A small grind up. If this is right off open, you might not even get paid, because when you factor in the implied volatility, your contracts are going to look like this. Like they're just consolidating pretty much. Even though the stock is moving in your favor, contracts are being held down. So that's why the implied volatility is super important. The next thing that you should keep in mind is the actual volatility of the stock. So earnings or any big news is going to make your stock very volatile. So with that, one, you can make a lot of money. The volatility is going to be priced in, so you're not going to make like I mean, you can still make a lot of money. Like I just showed you, this play over wherever it was like 86%, which is, that's huge. Like that's, as a scalper, that's an insane move. But with that volatility, you need to respect your stops more than any other day, because you can have a huge flush down in the blink of an eye. So even though the stock moves up a lot here, it goes from 395 to 387 in like 1, 2, 3, 4, 5 in 6 minutes. So that's like the entire average true range on a normal day in just a couple minutes. Like there's so many people watching this stock, so much profit taking, so many new investors FOMOing in, that this stock is going to be super volatile. So when you see early red flags, you don't want to be holding for too long, because the stock can blow right through your stop loss, and it'll really drop value in your contracts. Another thing with this volatility is that sometimes it can just go on huge runs with no pullbacks. So what I recommend is to not FOMO in. So don't go try to play an extended move with or honestly in general, but especially with no plan, just because if it does start pulling back on you, it can be a really quick pullback and really affect your contracts. So earnings day stocks are really nothing to play with, especially if you're a beginner. But even if you've been trading for a while, lower size, like you can still make a lot of money. So just be careful with the volatility, because it can pay you, so you can just go in with lighter size, but it could also really go against you quick. And if you're charting, or if you're setting your stop loss based off of like charted levels or something like that, so like let's say this is your consolidation and your stop is below the consolidation, you're talking about like at least a $5 stop, which is like really wide. On a normal day, your stop is going to be a couple cents, maybe $1 or $2. Like $2 is still a lot, but since this stock is so volatile, this what looks like a tight consolidation, you're talking from 85 down to 77, or if you do the tighter zone, you're talking 84 to 79. So that's still $5. That's a really wide consolidation. And let's say you got in here, you don't want to be holding through this because of what I just showed you. You'll be holding through constant implied volatility crush on your contracts. So you'll be, every little dip is really going to affect your contracts. And I think I missed something. Oh no, it's next. Okay. So the next thing is market correlation. So sometimes stocks with earnings or any big news, it's going to move on its own and not with the market. So you might be misled seeing futures pump and your stock stay stable, and then when futures drop, your stock might go up. It's because your stock, a lot of times when it has big news, it's just moving on its own. It doesn't really care what futures is doing or is affected, because this stock has so much volume this day that so many investors are making their own decisions on it, that what the market is doing isn't even affecting what's happening here. You still do want to watch futures, just because like that's part of trading, or definitely scalping. If you do some different strategy, it might be different for you, but as a scalper, you 100% need to be watching futures, because let's say futures does take a big fall, it can drag your stock down. It's just, you have to keep in mind your stock is going to move on its own a lot, so you need to be more focused on what your stock is doing at the time. Take futures into account, but keep it with a grain of salt, because this is going to do what it wants most of the time. And another thing with market correlation is that earnings stocks or big news stocks could affect the entire sector. So I want to, or I'll show you. Actually, let's go to the 15-minute. Just delete these. Oops. So, okay, Nvidia had earnings and clearly it pumped up a lot. Let's go to another chip stock, AMD. Let's see what happened. Look at that. It brought AMD right with it. So, this can cause market correlation to other stocks in the same sector. Just like this chip stock pumped, investors are assuming that this is also going to pump with it. Let me think of another. IBM, I believe. Okay, I didn't do anything. Whatever. But yeah, AMD and Nvidia are pretty much the same company, just a different brand. Like, they do the same exact thing. So when this makes a big move, this is going to make a big move with it. So this is also something to watch. This is probably also going to have a big implied volatility. So watch out for the same thing there. But it's not going to be as high as this one, just because this is actually where the eyes are. This is where the news was. This is like a side effect of this. So you can also watch if there's key levels you want to play on this stock, just for example, or any semiconductor stock. Let me pull up NASDAQ. So these are all the semiconductor stocks. Okay, this is the only one that's red. But yeah, this is pretty much this, I'm assuming, brought all of these up because this had such bullish news that people are expecting the entire sector to have that same news pushing everything up at the same time. And the last thing is swing trading, which you can make a lot. You could also lose a lot, which is why it's super risky to swing trade earnings, especially. So let's say the stock, instead of moving up, what did it move up? 27%. Let's say instead of that, let's just say it went to 330, or I mean, yeah, 330 is still a lot. I'm not sure what the implied move of earnings was, but let's assume it was a $30 move. At open, these 330 contracts are still going to be cheaper than when they closed. Just because what I was saying, that implied volatility, there's an implied move priced into contracts before this earnings release. So let's say it was plus or minus $20. So anything, what did we actually close at? We closed at 305. So any, like in this example, if it was a $20 implied move, anything from here to, what was it, 305, so any contract in this range, or if the stock opens up in this range, pretty much every contract is going to be down because that implied move wasn't hit. So the stock needs to have a move bigger than the implied move for your contracts to pay. So even though you might have been right, your position is still going to be red even after a big move. So like a $10 move, that's a lot, but you still might not get paid because the implied move was bigger than that. So playing earnings, either don't play it at all or play it with really light size, because the stock could still have a big move and you still not get paid on it, just because the way contracts are priced and their premiums, it has to be above the implied move by the open of the next day for you to get paid. And let's say you did swing, if you don't sell right at open, almost no matter what, you're going to experience contract decay. So what I recommend is literally when the bell rings, hit market sell, just to lock in whatever you made. So yeah, swinging earnings is extremely high risk. You can make thousands of percent, of course, but you can also lose 100% of your investment. So definitely don't go in with more than you're willing to lose. It can literally go down 99.9% overnight, and there's nothing you can do about it because you can't trade contracts overnight. And another thing that people talk about and think like, oh, this is a invincible strategy. What if I just buy 280 calls and then, or 280 puts and 330 calls? They're both so cheap. If one goes down 100%, the other one's going to go up 1,000%. What I was saying before is exactly why you shouldn't do that, because if it opens up in this range, they'll both be down 100%, and you just lost 2 full positions pretty much. So that's why I don't recommend straddles. If you do it with an amount you're willing to lose on both sides. Just because if we open up in this range, you're just like, your contracts lost pretty much all of the value that was priced into them. But that's trading earnings. Things you need to watch out for. Things to avoid. All in all, if you're a beginner, just stay away from earnings. It's like it's the riskiest thing you can do. Sure, it can pay a lot, but it can literally take away 100% of your investment very quickly. If you're swinging, it can be like right overnight, and there's nothing you can do about it. There's no risk management on that. It's really just a lottery ticket. You know, if you're looking to gamble, go for it. The returns can be high. It's just that, like buying a lottery ticket, you can just lose everything. So those are things you need to watch out for trading earnings. If you're a beginner, yeah, just stay away from it. But that's all. Peace.